This is lesson 6-5, reducing your Form 1040 tax liability. In other words, looking for ways to decrease the amount of tax that you owe. Now, as I've stated in previous lessons on income tax, the examples in this lesson are based on a particular year's instructions, okay? Every year the tax instructions change slightly, the line items change slightly, the percentage or amount of deductions or tax changes slightly. So just be aware of that this is not necessarily the case for all years that one might be filing income tax. The objectives of this lesson are to understand the difference between a tax credit and a tax deduction. Also, file Form 1040 with Schedule 1 adjustments to income, and file Form 1040 Schedule A itemized deductions. Here are some key terms for this lesson. I'm not going to go into each of them individually. You can see what the definitions are for these different terms. Tax avoidance, tax evasion, deductions, itemized deductions, tax credit, and everything that is listed here. So just review these definitions. Now, what exactly is the difference between tax evasion and tax avoidance? Put simply, tax evasion is illegal, okay? This is the illegal avoidance of paying taxes. Tax avoidance, however, is the legal means of using the law and a reputable accountant to come up with different ways to avoid paying certain taxes, okay? But to do it legally, all right? There are several high-profile cases of tax evasion. Almost daily you can see some news item about someone being charged with tax evasion. Many times they're mobsters or people involved in illegal activities that do not report their income. The average length of a prison sentence for convicted tax evaders typically runs 3 to 5 years in prison. So this is a serious offense and one that should not be partaken in. So let's look at some examples. Ty is filing his Form 1040 and his filing status is single. His adjusted gross income from line 8B is $87,651. Rather than use the standard deduction you learned about in section 6-4, which is $12,200 for single filers, Ty is using tax avoidance and legal deductions to lower his taxable income. He uses Schedule 1 and Schedule A to list $21,751 worth of deductions. He also had a child care tax credit of $1,211. What is his tax liability? Well, first of all, we're going to deduct his deductions from his gross income and come up with $65,900. Then we will look to determine what his tax is on that income and find that the tax on the $65,900 is $10,362. Next, we're going to take and deduct his tax credit, his child care tax credit of $1,211 and come out with his current tax liability of $9,151. Now let's look at another example. Ben and Akira Pasquale are married and have 3 children. Ben is a history teacher and Akira is a carpenter. They file as married filing jointly. Ben has a tutoring business, so he also files Schedule C. He also is paying off his student loan and will deduct the interest. Akira draws a cartoon for a local newspaper and also had to file a Schedule C for her business income. She was unemployed for several weeks during the year. Their W-2 forms are shown on the next slide. Now here you can see the W-2 forms for each of them from the school system and as well as from contracting, okay, for the two of them, for Ben and Akira. And now we can see some additional financial information in terms of taxable interest, ordinary dividends, refund from last year's state income tax, taxable business income, unemployment compensation. They won a prize in the state lottery, some educator expenses, penalty for early withdrawal of interest, student loan interest, medical expenses, taxes, home mortgage interest paid, and contributions. In addition, they had some casualty and theft losses. They had flood damage not covered by insurance. They had child care credits, okay? They had to pay for daycare when both parents were working. Okay, now we want to fill out their Form 1040 up to line 3B on page 2. Use the following for Social Security numbers. Remember to round to the nearest dollar when entering numbers on Form 1040. Now, this is something very standard when you're filing income taxes. You can round to whole dollar amounts. So here's the start of Form 1040, where they fill in their personal information, their names, their Social Security numbers, their address, their children, dependents that are down here, 2 daughters and a son with their Social Security numbers, all their wages from their W-2s, and some additional information that is shown at the bottom down here in lines 1, 2B, and 3B. So now let's continue on with filling out their complete income tax forms, okay? They need to complete the additional income portion of Section 1 so they can continue their Form 1040. Complete the additional income portions of Section 1 for the Pasquale family. Well, using the information provided, you'll notice they have taxable refunds, credits, or offsets of state and local income tax. That's $907. That's put up here in line 1. They have business income, which they put in line 3 of $2,970. And then they have unemployment compensation, which they put on line 7 of $2,400. This was all the additional information that was provided for them. Then they added all these numbers up and the bottom down here on line 10, and that shows a $8,977 of additional income. Now they carried this amount over to the Form 1040, and in this case it was line 8. They added it there, and then they added it up, so their total income now is $124,099. Now, continuing on with the Pasquale family, we note that Ben teaches a night course and bought $133 worth of materials for his class. These are called educator expenses, okay? Anyone who is an educator can deduct certain expenses. He also had to withdraw money from a CD account and paid a penalty. Certain CDs pay a penalty if you have to withdraw early, and these expenses are deductions from income for Schedule 1, and let's see what lines he should use for these deductions. So as you can see here on Part 2, adjustments to income, all right, he has educator expenses, which are shown here as line 11. That's where he put his $133. And he also had the penalty on early withdrawal of savings, which goes on to line 18 in this case of $57. Now, Ben is also paying off a student loan and paid $2,670 in interest for the year. Okay, so let's see where he enters that. Well, first of all, for this particular year, the maximum student loan deduction is $2,500 based on income. So therefore, he is able to deduct the $2,500 of his $2,670 interest that he did pay. Now we go back here to part 2, adjustments to income, and you can see that he adds it on this particular form, line 21, student loan interest deduction, and that's where he puts the $2,500. Now going back to Form 1040, he puts in the amount that he got from that deductions on line 10 of $2,690, and line 11 shows the adjusted gross income of $121,409. All right, continuing on, the Pasquales paid $12,176 for medical insurance. They also paid $600 for prescriptions, $5,240 for doctors, $2,300 for dentists, and $510 for eyeglasses. Medical insurance covered 80% of these expenses, so they only had to pay 20% of the medical bills. The IRS allows medical and dental expense deductions for the amount that exceeds 10% of a taxpayer's adjusted gross income. This amount is called a threshold. How much can they claim as a medical deduction? First of all, let's add up all their medical deductions, the $600, the $5,240, the $2,300, the $510, and come out with $8,650 for their total medical bills. Well, insurance covered 80% of this, so they had to pay 20% of this. So that comes out to be $1,730 medical costs that were not covered by insurance. So if we add these costs not covered by insurance to the amount that they had to pay for insurance, we come out with $13,906 of medical expenses. So this amount they can add to Schedule A, itemized deductions, all right? And that's right at the top here for medical and dental expenses. So they put their $13,906 there. They enter the amount from line 11 on 1040 of their gross income of $121,409. And then we multiply line 2 by 7.5%, and we come out with 9,106. We subtract that from the 13,000, and their allowable deduction for medical is 4,800. Okay, so you can see we have a percentage of their gross income that they can that any amount in excess of that percentage is the amount they can deduct for medical. Well, continuing on, the Pasquales had state income tax withheld, okay? They also paid real estate taxes, and they also paid mortgage interest. So how are these expenses entered? So let's add up the total amount. So the total state income tax withheld for the two of them was $4,088. So this is the total state income tax withheld. So we go to the form and see where it says taxes you paid, all right? So state and local income tax, the $4,088, the real estate tax of $6,213. We add these up and we come out with $10,301, and now we enter the smaller of 10,000 or the 10,301, and we come out with, for this particular tax year, we can deduct taxes you paid of $10,000. Okay? Then we look down a little lower and we see interest you paid, and home mortgage interest is fully deductible. So that's 9,110. So that we've put down here on line 8A as well as down to line 10. So continuing on, the Pasquales gave $987 to charities, okay? The highest amount they gave to a single charity was $100, okay? They also donated $450 worth of old clothes. The highest value of items they gave to any single charity was $120. So find the total of their charitable contributions. All right, now we take and go to where it says gifts to charity, all right? And so we see line 11, gifts by cash or check. Nothing was over $250, so the total amount was $987. And then other than cash or check, this was the old clothes that they contributed, $450, line 12. We add them up, and gifts to charity for them for that particular year was $1,437. Still continuing on, they had $12,034 worth of flood damage that was not covered by insurance, and they had a camera that was worth $980 that was stolen. So these will amount to being casualty deductions. So we deduct $100 from each of these casualty losses. This is the required IRS deduction, so these are diminished by $100 each. We add them up and we come out with $12,814 for their casualty deduction. Now again, we have to take and see how much this is in excess of 10% of their gross income. So we take 10% of their gross income, all right, and we subtract that from this $12,814, and the amount of their casualty losses that is deductible is $673. So again, we have to take and find out how much this is in excess of a certain percentage of their income. And we go to the tax form and see where it says casualty and theft losses, and that's where we put the $673 into that line item. So that's it for their itemized deductions. So now let's see what the total is for their itemized deductions. So we add up the total and we come out with $26,020 of itemized deductions. Now going to Form 1040, we see here for standard deductions or itemized deductions, this is where we submit the $26,020, okay, and we add, and we submit also on line 12C, and so this is where we put all their itemized deductions on the 1040. Okay, so now we've taken care of any adjustments to income or itemized deductions, and we want to see what their taxable income is now and what the actual tax is. As you can see, we're going to subtract this $26,020 of their total itemized deductions from their adjusted gross income of $121,000 and come out with a taxable income now. This is the amount that they're going to be actually taxed on, which is $95,389. Now we're going to look into tax credit. Now, they pay for daycare, okay? So after reading the instruction booklet, they found they could claim $1,213 in child care credit for this particular tax year. So now let's see where we put that on the tax form. Well, first of all, we figured out what their tax is. Their tax is $12,700 that they have to pay. All right? Now, notice on line 19, it says non-refundable child tax credit or credit for other dependents. And that's where we're going to put our $1,213, which is their tax credit. All right? They subtract that from their tax, and they come out with a amount of their total tax now is $11,487. So this child care is a tax credit where they actually deduct from the tax that they owe to come up with a new total tax. Now we're going to determine whether or not they had enough money withheld from their paychecks. Okay, if we go back to the W-2 forms, we can see that their employers withheld certain amounts of money for income tax, and we're going to see whether they withheld sufficient amount. All right, so now we're going to look at that, and we're going to see that from the Form W-2, they had $9,266 withheld. But remember, their total tax was $11,487. So they owe more than was withheld. So if we subtract those two amounts, we come out with a value of $2,221. And this is the amount that they owe the federal government. So basically, when they file their tax forms, they're going to have to include a check for $2,221 or transfer from an account to the federal government that amount. So that's the amount that they end up owing.